Welcome back to our second session, part 2 of the day. Like I said in the beginning, for the rest of this session now, I want to take this time to actually now give you an overview of the subject, and I want to take this as a reminder, and this is now the revision part of our subject. So I just want to remind you of where we started from, what is it that you need to know at this stage, and thereafter I think we'll talk about the assessment, the upcoming assessment, and what you should expect in the exam. Okay. So firstly, where did we start from in this subject? I want to remind you, please remember we've just been talking about, if I could connect what I'm talking about now to what we just finished talking about, the concept of highest and best use of a property and the potential of a property. All those refer to normally, all those are legal terms which are highly connected to the legal rights of a property. So property valuation 2 being so much about commercial valuations, we know that the value of a property is usually determined by the rights which that property has. So in this instance, the value of a commercial property, just like any other property, is so much connected to the legal rights which that property has. And one of the important legal rights which that property has would be the zoning rights, and then the rights given to that property according to the town planning scheme. Okay, so that is why I started this subject by reminding you on a topic that we started in the previous year on the calculation and the practical aspects of the control factors in the town planning scheme. So we need to remember the land use exercises that we did and the control factors in the town planning scheme. The control factors in the town planning scheme, there are basically 6 control factors. Control factors in the town planning scheme. One, there is density. 2, there is floor area ratio. 3, there is coverage. 4, there is what? Height. 5, there is parking restriction. These are the 5 major control factors in a town planning scheme. So at this stage and right from the beginning, I wanted us to make sure that we understand how, first and foremost, get the theoretical definitions of those control factors, and then know exactly how those control factors work together to determine the size of a development that can be put on a given stand. So what I expect you to know, and it's a reminder, know exactly how those control factors work together to control development. And most importantly also, know how the parking requirements also restrict the development that can be put on a given stand. Okay. So that is I think the starting point of our revision. I gave you a full set of land use exercises to demonstrate exactly how those control factors work together in practice. So please go and revise those sets of exercises that we did. Okay. That was our beginning. Then the next important topic that we started with was the leasing of income producing properties. Now, valuation 2 being about commercial properties, we started with the concept of leasing. So allow me to sit down as I take you through that presentation now. So we said when you are valuing an income producing property, the value of that property is going to be determined by the income which that property generates. So where do you get that income? So the income of that property is going to be determined by the agreement between the owner of the property and the person that is renting it, who is the tenant. And then the agreement that those two parties enter into is what is now deduced in a lease agreement. So that's where we started from. So in this discussion, we looked at the leasing of properties. I expect at this stage that we have quite a good understanding of the concept of leasing. So in as much as I'm not going to take you through, this is a revision, by the way. So I'm not going to speak through the whole of this slide once again. We've already done that. So now it's just about me reminding you of the key concepts on the relevant sections of these chapters that we've talked about, which you know, which probably should also even expect to be examined on. So under the leasing of income producing property, that is what we started with. The major aspect of this subject was the last bullet, that leases impact the income potential and riskness of income producing property. The income, if we say the value of that property is going to be determined by the income which that property generates, therefore the condition of the lease is going to have an impact on the income of that property as well as its market value. So please go and do a revision of the different types of leases. Before we probably even look at the different types of leases, we also talked about the market for space. What determines the rental values for properties? How are rentals determined? And here we discussed that rentals or space, property space, just like any other commodity, is the price that a person pays for space in the form of rentals is also determined by the market forces of supply and demand. So rental rates are also a function of how much of that space is available on the market against how many people are actively looking to own that space. So the normal economic principles of supply and demand do apply even in determining the rental rates for commercial properties. And it's a normal economic principle when the supply for any commodity is high and the demand is low, the price is the determinant. Yeah. So the same principle does apply to property. So that is basically the indication, that was just the reminder rather of how rentals are determined. Then also I was reminding you of how is the space for commercial property measured. So please, let's go and revise and know exactly the SAPOA methods of measuring floor areas. There are basically 4 standard measures. So let's know exactly what the construction area is. Let us know exactly what the building area is and what they are used for. That is very, very important. I think from the previous assessments that we did, a number of you can define these areas, but I think a good number do not understand exactly what are the intended uses of these different SAPOA measurements. So construction area, know its definition and know what it is used for. Construction areas are used mostly to determine the building costs. When you are determining the cost of that building, you are going to use the construction area and see exactly how the construction area is defined. Also importantly, is the other measure is the building area. Building area is the area that is used now to determine the planning regulations. The planning regulations, like the control factors in the town planning scheme, you use the building areas. So building areas, know the definition very, very well. More importantly though, to commercial valuations is rentable area. Know exactly how rentable area is defined, and this is mostly the area that is used to determine the income of the space. Know its definition. The use is quite obvious. You use rentable areas to determine the income that space could generate. Usable area. So basically, just to cut my talking short, please let us go and revise and remind ourselves of the SAPOA methods of measurements. This is an extremely important topic, and that's why I had to include it in this discussion before we even started looking at the leasing aspects. All these notes, every one of you has these notes on Blackboard. All right, so please take that one seriously. Don't be surprised at any time. Then we went into the aspect of leasing seriously. Now, this stage we all know what leases are. A lease agreement basically is that agreement between the landlord and the tenant. Then we need to know exactly the certain objectives of the lease. Objectives of the lease basically is to protect the landlord's desire to assure occupants and income for a period which the lease covers, so that it prevents losses in the form of vacancies. Then these are certain legal terms. I expect all of you to at least know the essentials of a lease, and more importantly, know this slide, the specific aspects of leasing. These are all potential exam questions. We should know exactly what a long lease is. I'm sure we know, definitely we know. Let's know what a long-term lease is. A lease is not a lease if the rental is not specified and it's not enforceable. The property also needs to be defined. The duration should be given. The lease should start from a certain point and expire at a certain point in time. So all these aspects of leasing, please let us know them and understand them. Options, we know what an option is. Right of first refusal, we should know what that means in relation to property, to leases. And that term, we should know what it is. Yes. Very, very important in property. Subleasing, cession, assignment, all those are quite well specified. You should know the difference between assignment and the sublease and which one is better. Know exactly what a landlord's hypothec is. These are just certain common terminologies that are used in leases. So please let us do a good revision on those types of leases. A lease can also be cancelled depending on the agreement between the two. Know how cancellation of leases is done. And termination of a lease. There are always provisions by agreement how a lease should be terminated. So those are the general provisions of a lease agreement.
For interest sake,
Yes, please.
termination and cancellation is when you want to stop the lease, and termination.
When it comes to an end.
Okay.
Cancellation is, for example, we've agreed that this lease agreement is for 1 year, from January to December. Cancellation is in June. You can break the agreement. You've cancelled it. You give reasons,
Yeah.
and there are normally provisions to
In the
specify
contract, yeah.
exactly.
Okay.
Whereas in December, that's the end of the term, so that's termination. So that is now when at termination time. That's now you either enter into renew it. So that's basically those are the two differences.
So cancellation is by default.
Yes.
Yeah.
Cancellation is by default. Termination is by predetermined agreed time.
Yeah.
When that time comes, you choose either to renew it or not.
Yeah.
Yes. Good question. Okay. Leases and responsibilities for expenses. You see, when you are valuing an income producing property, you know the value of that property is going to be determined by the net income which that property generates. Meaning, the expenses, the income that property generates, you subtract the expenses. So you need to know exactly how the lease for your property is structured so that you can correctly apportion the expenses in the all capitalization equation. Because there are certain expenses which the landlord pays on behalf of the tenant, and then he bills them back. Those are what they call recoveries. So in valuation circles, oftentimes recoveries are treated as income to the property owner, not as expenses. So that all depends on how the lease is structured. So those leases do exist. Then most importantly, please, let's go and remind ourselves on the different types of lease. Different types of leases. Gross lease, let's know what a gross lease is. Usually a gross lease, that's where the tenant just pays the amount, and then the landlord is responsible for all property operating expenses. So lease with operating expense recoveries is what I just talked about. That is where the landlord pays on behalf of the tenants, especially for shared utilities. Then he bills them back. He recovers that based on the space that they occupy. So usually recoveries are treated as income to the property. So let's know gross lease. Ground lease. Let us know what a ground lease is. the different types of leases, let's all please go and do that revision again to know what a ground lease is, what a building lease is, what a lease and a lease back is. I'm sure at this stage we all know those things from the head. I gave you a test in the June exam. I gave you a test on this, and the June exam generally, the results were, the online June exam, the results were generally not very, very good. A lot of people struggled. So I hope you don't struggle this time again. So let's go and know those different types of leases: ground lease, building lease, and the lease back. Also, know the different types of leases. The net lease, know what a net lease is, a double net lease, and a triple net lease. Those are also different types of leases which do exist. Okay. Examples of items that can be built back or considered as recoveries. Those are the common examples of items considered as recoveries. And mostly, as you can see, most of these are shared facilities or shared items. Okay. So that was the small but extremely important discussion on leasing. Why did we start with this? It's because it's the lease agreement that determines the income which that property, or the potential income which that property is capable of generating. So it's that income now which you are going to use to determine the value of that property. For that reason, it's extremely important that you understand the different types of lease agreements which could exist. And it's therefore also very important whenever you are doing a commercial valuation, it's always, if you can, it's always important that you have access to the lease agreement so that you know exactly how that lease is structured, so that you can properly apportion the income for that property as well as the expenses for that property. Okay, so leasing is a very, very important aspect of commercial property valuation. All right, so please, like I said, we are just doing an overview of what we've done, and it's revision time. So please make sure you understand everything that we've covered concerning lease agreements. Straightforward, eh? Okay. Let's quickly now look at the next major topic. The next topic that we did was now the actual valuation of income producing properties. Valuation of income producing property is basically what valuation 2 is all about. So, after having talked about the lease agreement, we now understand exactly where the income for that property comes from. So we then talked about the income method of valuation. That's mostly the method that you use to value income producing properties. And as a reminder, I was trying to give you the different names that I used to refer to the same method of valuation. All income producing properties are valued using the income method of valuation. And the income method of valuation is a method that is identified by so many different names. Some people refer to the income method of valuation as the indirect comparison, because even within the income method of valuation, there is an element of comparison. And there are two very important components of the income method which are derived from comparable properties. These are basically the capitalization rate as well as the rentals themselves. When you are doing evaluation for a property, you look at the contractual rental, which is the rental that that property generates, and then compare it to other similar properties in the market. So ideally, if you are valuing a property, remember we just finished talking about the concept of highest and best use. So ideally, it's always advisable to use the market-related rentals to capitalize your property, because that then gives you the highest and best value for your property. So because there are instances where the contractual rentals may be lower than the market rentals and vice versa. So the income method of valuation is called indirect comparable sales method. That is one. Other times, depending on also the type of literature that you could be reading, the method is also sometimes referred to as the investment method, or the income capitalization method, or just the income method. At this stage, we should already know the basic capitalization formula. This is the income method of valuation. Theoretically speaking, one could argue is the easiest method of valuing property because it's purely based on a formula. So the value of that property is determined by dividing the net income of the property by the appropriate market-related capitalization rate. That's the general capitalization equation. So, base capitalization formula, gross income minus expenses will give you the net operating income. Then you divide the net operating income by a market-related capitalization rate to get the market value of your property. So know exactly the definition of capitalization and know exactly what a cap rate is. Please, this is revision. The terms that I'm talking about, you already know them. I'm just overemphasizing them. They are not new at this stage. And also, most importantly, the income method of valuation is very, very sensitive to the capitalization rate. For that reason, the correctness of a commercial valuation is so highly dependent on your choice of capitalization rate. If you pick a wrong capitalization rate, which is not appropriate to the type of your property, it's good. The value that you are going to come up with may not be the correct value for your property. That's why here I'm insisting that a capitalization rate needs to be market related. Capitalization rates should not be historical. I know the difficulty that is encountered in determining appropriate capitalization rate. That does still not mean that capitalization rates should be fixed. Capitalization rates are determined by markets. So if markets change, there's no way why capitalization rates should remain the same. So capitalization rates should also change depending on the market activities. All right. The basic valuation process, that one is very straightforward to us. You first and foremost determine the gross income, determine the expenses. You subtract your expenses from your gross income to get your net income. Then choose an appropriate market-related cap rate. To get your net income, divide your cap rate into your net operating income, and then you get your market value. So this is extremely easy. So know exactly then what constitutes the gross income of a property. That's where the conditions of the lease become important. The income of that property is going to be determined by the lease agreement. So the condition of the lease should determine the income which that property generates. The condition of the lease determine the rental payable as well as the obligations of each party. So then it's very important therefore for you as a valuer to investigate the different lease options so that you correctly determine what constitutes the actual income for that property. So in investigating the leases, the valuer should take note of the escalation clauses, the expenses recovered, and all those types of clauses, specific clauses in a lease agreement. Because it's from the lease agreement where the income is derived. So please, let's know that theory very, very well. Then what constitutes operating expenses? Those are the things that constitute operating expenses. At this stage, I expect you to know how management fees are calculated. I expect you to know how assessment rates are calculated. I expect you to know how insurance for property is calculated. You know. Maintenance is an allocation, then security and everything else. So please, let's know what constitutes the full range of operating expenses. And let's know, especially assessment rates and insurance, let's know how these two items are calculated.
Maintenance and insurance.
Yes. We've done so many examples on those two. All right. Then, most important, please, let's know this slide. Let us know this slide. I want you to know the difference between a capitalization rate and the yield of a property. An extremely important slide, please. I'm overemphasizing here for your own benefit. Let us know the difference between those two terms. Mathematically, these two terms are the same. They all use the same formula, but let's know how they differ. The initial yield is calculated based on the contractual income of the property, whereas the capitalization rate is calculated using the full market income, market-related income of the property. Okay. So in short, the capitalization rate assumes the full potential of the property, the highest and best use of the property. Whereas the initial yield only assumes the actual contractual income. It's very important that we know the difference between these two, because oftentimes out there in practice, most valuers use these terms interchangeably, but there is a difference, and that is the difference. You use the yield, you use the actual property income or contractual income in this instance, to determine the yield of the property. Remember, it's all yearly, first year's yield. Whereas we use the capitalization rate, to calculate, to work out the cap rate, you use the market-related income using the general capitalization formula. Okay, please let's go and know that. And if you need to do further research on that slide, extremely important. Also, you need to know the capitalization rate is a very, very key variable in the whole income capitalization process. So let us know exactly the factors that influence the capitalization rate. One of the most important factors which influence capitalization rate is the risk of the property. Risk generally speaking. Get me correctly here. Risk, generally speaking, will influence the capitalization rate. And risk can be on two fronts. One could be general risk as well as property-related risk. So let's know those two differences. Risk generally could be economic risk when the economy is unstable, political risk when the political climate is unstable, which scares away investors. That will affect the return for property, which will affect the capitalization rate, which will affect the vacancy levels of property. So then there are also property-related risks as well. Quality of the tenant, the quality of the property itself, its location, the provisions of the lease, those are now property-related risks. So let us know the various types or various factors which do influence capitalization rates. Let's know the general risk factors and let's know the general property-related risks. Extremely important because cap rates determine the value of that property. So let's know what makes or what determines the capitalization of the property. Otherwise, strictly speaking, the cap rate is derived from the market, meaning point number 2, capitalization rate is going to be determined by the sale of similar properties. So the prices which investors are going to pay for those properties is usually a consideration of all the risks that are attached to that property. And that's why now we talk about all these risks, because that last price which that investor is going to pay for comparable properties is also a consideration of all the risks that are associated with that property of yours. Okay, extremely important. Then here I was just now introducing you to another scenario of the concept of bottom slice and top slice calculation. There are instances where the rental for a property is above the market rentals, or the rental for a property is below market rentals. So this is basically now, in this instance, I was bringing to you a consideration of exactly what affects the value of a commercial property. The value, when you are valuing a commercial property, the value of a commercial property is made up of the capitalized value of that property plus the effect of the leases, as well as the value of any unutilized land, which is in this instance the potential of that land. Those are the three things. When you are valuing a commercial property, you are going to capitalize the market-related income at an appropriate capitalization rate. Then look at all the leases that are on that property to determine the income which those leases do command. And then determine whether those lease agreements, depending on your date of valuation, determine whether those lease agreements are above market or below market. And basically that's what we refer to the top slice and the bottom slice lease. So simply put, a top slice lease is that lease where the tenant is paying above the market rental. Whereas the bottom slice is that portion of the lease agreement where the tenant is paying below market rental. So in this instance, in this illustration, when you are valuing that property, you are going to capitalize the market rated rental, the 100,000, the 100 rand per square meter into perpetuity. Then add the effects of the leases. So by the effect of the leases, normally that one discussion is covered very well in this slide. The value of the lease is going to be determined by discounting the unexpired period of the lease at the time of your valuation. Bullet number 2. Determine the amount of months left in the lease and then compare the actual rental to... Basically, this is the slide that shows you how you determine the top slice rental as well as the bottom slice rental. This is a complicated exercise. Such exercises are used when you are valuing multi-tenanted big commercial properties. All I wanted you to know is if you are doing that investment property correctly, then you need to take into consideration the effect of leases on that property. I've given you many examples on the top slice, or not many, but one very good example on the top slice and bottom slice calculation. It is still on Blackboard. Yes, on Blackboard. I gave you as an exercise for all of you to just practice for knowledge purposes. Okay. Then conclusion of evaluation, basically that's now what constitutes how you conclude the market value of a commercial property. Market-related income, you capitalize it to get your capitalized value. Then you add the effect of leases, which is the net present value of the leases with the bottom slice and the top slice. The top slice results into a positive, the bottom slice is a negative. So the net effect, if it's positive, then you add to the capitalized value. If it's negative, then you subtract from the capitalized value. Then you add any value of unutilized land. That gives you the value of a property. So basically that is the theory of commercial valuation. And ladies and gentlemen, I gave you some practical exercises on this theory of commercial valuations. So all I want you now is just a reminder, please go and revise the practical side of this commercial valuation. This is potential exam questions. So in short, please, just like on the land use exercises, know the theory of the control factors and know their practical applications. We've done both. So go and revise that. The same with the income method. We've done the theory and we've done a few exercises. So go and know both. You'll be assessed on that. Okay. So that is that's the overview of the income method of valuation, and that is basically a recap of stuff that we already know. And it's in the exam, for sure. Yes. Okay. Any question?
It's clear.
Very clear. Can we take another 15 minutes break before we come to our last